All right, how was break, everybody? Thrilling? Well, I'm glad to hear that. We are now ready to have some serious acronym fun. RESPA, TILA, TRID, Regulation X, GFE, Early TIL, HUD 1, CFPB, Dodd-Frank, Dodd-Frank. What does this all mean? Somebody help me, please. Regulations. So where to start? The book kind of jumps all over the place. So I guess RESPA, Real Estate Settlement Procedures Acts. This was like 1974, often referred to as part of Regulation X. This did a lot. Require that borrowers receive an early disclosure about what's going on. However, what happened in the 2000s was when the government said, okay, you know what, all these foreclosures are happening, what is the root cause of this? Lenders, you guys need to do a better job. So they created the Dodd-Frank Wall Street Reform and Consumer Protection Act. It is one of the most comprehensive financial regulatory system reforms in decades. Really, the lawmakers really went ahead and took a look at the entire system and made sweeping regulations. In doing that, they created a lot of redundancy. Some of those redundancy was the early truth in lending and the good faith estimate. Also, the final truth in lending and the HUD 1 were very redundant. So what they said is, you know what, let's see what Dodd-Frank did or wants, which is the truth in lending. Let's see what we had before, because RESPA is still on the book. RESPA didn't just go away. It just, Dodd-Frank added to it. So they said, okay, well, instead of causing everybody to have to do good faith estimates and early truth in lending, which is the exact same information, or majority of the same information, let's combine those two together and call it the LE. What is the LE? The loan estimate. Fantastic. The same thing. Loan estimate, we get a good amount of time beforehand, and then right before closing, we're going to get the closing disclosure, which combined the HUD 1, which we're all familiar with if we bought a house before 2000 or October of 2015, and then the final truth in lending, which is what we get now, which kind of encompasses, or which is what Dodd-Frank created. Now we get the combined happy form of our closing disclosure. So we're kind of taking what Dodd-Frank wants, what RESPA had, combining them together, so it's really still just one document for both of those situations. So when we combine what Truth in Lending Act and RESPA had, we call it the TRID, or TILA RESPA Integrated Disclosure Act. Are we having fun yet?
Oh, yeah.
I know that I am. In a previous life, I worked for AT&T, and I was very into acronyms. When you work for a company whose name is an acronym, guess what? You get acronyms. And I was in the wireless industry, late 90s, early 2000s, when just all sorts of new technology was popping up. So acronyms had acronyms for acronyms on everything. And I'd be on the late night IT conference calls, and my wife would be like listening to me, and she's like, I couldn't tell you anything that you were talking about. You were saying more acronyms than you were actual words, and people seem to be listening. What do you do for a living? And I was like, well, I get on the phone and I spot off acronyms and I sound important, and then people get off the phone and stop calling me until the morning. Well, that solves that. So that's kind of where we're at right here in this slide. What we really have to understand is what the federal government was doing. We get past all this and saying, you know what? We had RESPA, that did some stuff. Lenders were shouldering some of the responsibility in the federal government's eyes for the mortgage meltdowns that were happening in the mid-2000s. We need more comprehensive regulations on what lenders need to tell the consumers. You have Dodd-Frank. Dodd-Frank had some things. RESPA had some things. They combine that together to get the new disclosure forms. So, what are some of the things that need to be on this loan estimate? HUD 1, all that good stuff. So you get a copy of the HUD 1 on 576. HUD 1 gives a good example of what used to happen right before closing. Before October 2015, you're supposed to get a HUD 1 24 hours before closing. That did not always happen. Stuff still got done. What this is showing a real detailed accounting of all the dollars and cents, and it ends with, at the bottom of page 1, which is kind of more of the summary page, the cash from the borrower and cash to the seller. Very important numbers there. For this real estate deal that the HUD 1 on 576 represents, a lot of things got to happen beforehand, but the final thing that typically has to happen is that the buyer or the borrower walks into closing with a check for $49,1864, and in doing so, the seller walks out of closing with a check for $28,558.69. Very important. That's essentially what the HUD 1 did. We continue on to the next couple pages. We're going to start talking a little bit more about the loan estimate. And here's an example of the loan estimate on page 581. Part of the loan estimate is, let's see where that is. Yeah, we'll get to that in a second. Part of the loan estimate has some things in it that have zero tolerance, or no variance is what they call, not tolerance, but variances. Some things have 0% variance. That means from the loan estimate to the final closing disclosure, there can be no change. So who is creating the loan estimate? The bank. Well, what type of things should the bank not change between when they've given the loan estimate and the final closing disclosure?
Interest rates.
100%. These are the things that the lender charges for. Premiums, points, loan amount, underwriting, processing the loan, all those things. Why should there be no tolerance in there? Who has 100% control over those things? The bank. There's stuff that the bank cannot change. From when they say, hey, we will loan you this money for this amount, from when you originate that loan, or when the loan estimate comes through and when the loan actually closes, those things cannot change. Now there's another bucket of stuff. It's the 10% variance. These are items that the bank is not charging for, and I'm at the bottom of page 579, and we just bumped up to the top of 580. Some of the stuff that has 10% tolerance are things that the bank does not have direct control over, but is telling the consumer or the borrower, you have to have this service, and you have to use this person for the service, or choose from our list of the service. An example of that would be the appraiser. Most lenders are going to have relationships with appraisers in a market where they do business. Banks are not going to be really interested in you as a borrower or the buyer of the property to choose your own appraiser. Why is that? Why does the bank not wanting me, who if I'm a borrower, to choose my own appraiser? That's my boy, and he's going to do whatever I tell him to. So what the bank wants is the bank wants an actual appraisal, of arm's length transition appraisal. Especially myself, the last home I bought, I was my own real estate agent. And so the bank had all sorts of red flags on that, and they were looking at everything I did very, very detailed. Also because my personal financial situation, because my wife and myself own 2 or 3 companies and rental properties and all sorts of other stuff. She works, most of her work is commission-based, 100% of my work is commission-based, so there was like 700 pieces of paper that I sent in for my last loan, which was ridiculous. But they want to make sure that appraisal gives an actual number, because for the example we talked about before, the bank is not loaning money on the value of the house on what I think it is or what I'm paying for it, but on what it's worth. Because if they have to foreclose, the spread between what they have lent me and what their appraiser says, that's their cushion. That's where the bank is going to have their comfort level. So there's some that you have a 10% variance, because the bank does not have necessarily any control over Joe's appraisal. If Joe's appraisal services raise prices in between the time that the loan estimate came out and the final closing disclosure comes out, but they're going to say, you know what, it is going to be within 10% of these, because we as the bank are telling you, you do not have the choice, consumer, to shop around. So we're telling you that the numbers are going to be within 10% of this. Then you have some stuff on the loan estimate that is going to have an unlimited amount of variance there, or an unlimited tolerance. These are things that the lender could care less about who I choose as the borrower to use. This would be cost of homeowners insurance, the borrower, or the escrow agent. Sorry about that. That's going to cover the closing attorney as well. Who gets to choose a closing attorney? Buyer. I know I've seen some attorneys, the attorney that I use mostly, he can do a closing that's just all cash deal for a few $100s. And I've seen other attorneys who have a real complicated closing with multiple loans, things like that, charge over $1,000 for a closing. Wide variance, different levels of service too. Other thing in here that has unlimited tolerance, which is kind of a little bit different than what we would think, is the mortgage interest, which is strange. Because we looked over here at the stuff that has no tolerance. We're looking at points, origination fee, yield spreads, and things like that. The actual interest rate has an unlimited tolerance. I find that a little bit strange. Because I would say that if I was shopping for a loan, I want to know exactly what my interest rate is going to be, or I am not choosing that loan. But the unlimited tolerance has mortgage and interest on there. So that is what it is. So let's back up a little bit and talk about where situations the TILA-RESPA integrated disclosure applies. And I'm back on 575. So, what does TRID apply? Loan for the purchase or refinance of a home? Yes, 100%. Loan for vacant land? Yes. Construction loan? Yes. What is in common with all three of these? Begins with an L, ends with an N, has OA in the middle. Loan. You got it. So, thinking about that, is a cash deal. If I'm going in to pay for cash for property, are any of these disclosures required? What interest rate am I paying if I'm paying for cash? What loan origination fees am I paying? Do I have to be even messing with a bank? I don't call my bank and say, hey, can I write a check for this amount of money? And they say either yes or no. And typically I can do that online. And I say, okay, great, I can buy this house, or no, I can't buy this house. And then go from there. Seller finance. If the seller is makes less than 5 loans. So when they come up with this, they say, you know what, we don't want to inhibit the general public from doing seller financing. Seller financing is great. I have a lot of investors right now who started investing properties mid-2000s who are now selling their rental properties to owner-occupants. And they're carrying the finance. The investor came into the deal wanting a long-term return. Sitting down with myself, we looked to say what the market was when they purchased the property. Down here, where the market is right now, here in 2018, up here, buy low, sell high. However, a lot of the investors said, you know, I still want a continual stream of income. I still don't want this investment to go bad. I don't want to really do anything different with it. So they say, okay, great. We'll go ahead and market your property for sale, and we'll also put in there that seller financing will be considered. A little bit risky, but deal I put together a couple months ago is getting 6.5% interest on it, and he's they put with a 50% down payment. So I was to a family who was having difficulty going through a conventional means of getting it, having tons of cash, tons of income. Just some of their other things that happened in the past weren't resolved yet. So with 50% down payment, that means there's plenty of room there where the seller financer has to foreclose. There's still plenty of meat left on that house after spending $10,000 in 4 months foreclosing on a property. So, even there, they bought the house. I think the example was the borrower or the investor acquired the house. I think we bought it for like $35,000. He put about 10 into it. Just sold it for $85,000 with a $45,000 down payment, and they carried $42,000 some odd amount at 5.5% or 6.5%. Everybody wins on that. But if that seller is doing that as a business model, not just as a one-off, they are now becoming, under the rules, if they're doing more than 5 of these, then all those disclosures and acronyms that we talked about before and timings and all that stuff have to apply to them. Because that's saying, you know what, you are no longer a seller financer, you are now a bank, because you are doing this as part of your business model. HELOC. What's a HELOC? Home equity line of credit. What is that?
Taking equity out of your house and getting to get availability of cash.
Yeah, so essentially getting cash from the bank and using your home equity as collateral. I know a lot of investors who got into real estate investing by using a HELOC loan to go ahead and acquire the property, hold it for 6 months, do all the renovations, get renters in there, and then go back and get traditional financing for it. Reverse mortgage. See a lot of ads for this. If you own your house, you can go ahead and sell your house to the bank, and the bank will give you a little bit of money each month to live off of. And then at the end of that time frame, the bank then owns your house. That is not falling underneath the TRIE. Commercial. Why is it commercial covenant? That's what I would think.
Takes years to build properties, take time, so it's longer.
Right. So we talk about somebody's primary residence for the living? No. Somebody who's buying commercial property should have some understanding of the business that they're getting into, and then become less of general public and more of big evil business. So government says, you know what, if you're going to be buying something for your business, we don't necessarily need to protect you as the consumer. There's still tons of regulations out there, but all these extra disclosures don't need to happen. It's really to protect the average consumer, to make sure that everybody has a house that they and their family can live in. What about personal property? No, only applies to real property. Any questions on that? A similar grid is on page 575. So, let's talk about the loan application. At loan application, Telerespa applies. First thing you get is you get your handy dandy housing and urban development booklet called Your Home Loan Toolkit. This is a nice little booklet. I don't think there's a copy of it in the book. I'm sure there's not. But it kind of gives you, as the borrower, as the consumer, some basic information. What is a loan? What's the closing process? What is the closing disclosure form? What is the settlement? What are all the different pieces there? How does it work? What's the difference between a fixed rate mortgage and an ARM? A lot of people around here got ARMs. What does the A in ARM stand for? And which way did their more interest rates adjust? Up. Same loan, same amount of money owed, different interest rate. Sometimes they were getting them at like maybe an introductory interest rate of 1%. And then it would jump up to prime plus 6%. And all of a sudden their 1% turned into a 9% interest. And all of a sudden their nice affordable $600 per month turned into a nice unaffordable $900 per month. We were going down slippery slopes. So that HUD booklet, Your Home Loan Toolkit, describes these different types of loans and things along those lines. The loan estimate. Talk a little bit about that. It's a 3-page loan estimate, formerly called the good faith estimate, to compare loan conditions from one lender to the other. And that is on page 581. So, our loan estimate. We're talking about, can this amount increase after closing? Not what we talked about where things can increase between when the loan estimate comes out and the final closing disclosure comes out, but stuff that can change after, or can this amount increase after closing? In this loan right here, can the loan amount, the amount of money that's gonna be lent, the amount of money that's owed, will that ever increase after closing? Not on this loan. Or is there such a thing as a loan that does increase the principal? You have a negative amortization loan. Lots of times, if you have like an interest-only loan, lots of times those payments will end up being deferred to like maybe the second year or something, where you don't make any payments for a year. You see that on crazy one-off commercial deals where somebody who has a lot of assets might put something else up for collateral, but has cash flow issues, needs a unique loan product like that. We're talking about somebody who is in a different income class than myself looking to get that. I've never seen that on a residential property. Interest rate. This is a fixed rate interest, a conventional 30-year fixed interest, and their interest rate is going to be 3.875. Other types of loans, like the adjustable rates, can change. Those things can change based on a pure time schedule. They can adjust based on different indexes. Really, they can change on a lot of different things. Continuing down the loan estimate, we're talking about the monthly principal and interest. Can this amount increase after closing? No. The only thing, sometimes, I know my mortgage changes fairly regularly, because what are the two things that are included in my mortgage that are not on the loan estimate?
Insurance.
PITI, principal interest, are on the loan estimate. TI is not. The TI is taxes and insurance. Because Bank of America does not have any control over what Guilford County wants to do here, and they don't have any control over Erie Insurance on what they do here. So we're asking the bank to say, you know what, is this stuff going to change? Well, you know what, this is outside of the bank's control, so that's not even on the loan estimate, but we're talking about these two things. So if we know that the loan amount's not going to change, the interest rate's not going to change, the principal and interest is not going to change either. So if there's a yes for one of these two, then that monthly principal and interest will change as well. Is there a prepayment penalty? Yes. A lot of loans do have a prepayment penalty, but just for the very beginning of the loan. Banks make money on loaning people money. They get money by asking people to deposit money in their bank and charging them less interest than they're charging someone to loan. And that difference between what they're giving you as a return on your savings account or CD versus what they're loaning money out at is typically how a bank makes money. Unless you bank at one of my banks who just likes to charge me random fees for being a valued customer and having right bank accounts with them for so long. So, let me get off my soapbox about that. Balloon payment. What's a balloon payment? Party time. What is it?
The principal at the end that you pay, like if you pay large fee.
Yes. In a way that we're not understanding, but you are correct. At the end of a loan, if the last payment you make is more than your monthly payment, that's a balloon payment. Lots of times, you'll see a 5-year commercial loan where the whole loan is due at the end of the 5 years. So you might have a loan for $1 million, and at the end of the 5 years, you paid a certain amount, and at the end of that 5 years, you owe $764,000. Where about 4.5 years into that loan, you start looking for another loan product. Or talk to that bank and say, hey, I would like to have a new loan. So when this balloon payment becomes due, I would like to have another 5 years of loan. Lots of times banks will do that with commercial loans to ensure that they are being protected and not lending out money in large amounts at an interest rate that's below what is out there now. Because right now interest rates are creeping back up again, so a lot of commercial loans right now, especially for large amounts, aren't being offered for very long terms because everybody's thinking that interest rates are going to be higher in 2, 3, 4 years from now than they are today. So banks are like, all right, well, I would love to write you this commercial loan for this $1 million to buy this new piece of property and get your business running and all that stuff. However, I'm only going to write it for 2 years. So that's a balloon payment. You typically don't see that in a conventional residential mortgage. Payment calculations, year First 7 years, this person is paying $1,000.50, and in years 8 through 30, $968. What is the difference between those two? Mortgage insurance, after year 8, the bank is estimating that they will have 20% equity in their house by then, and that is good. However, if you are the consumer in this and after 5 years the housing market has continued to go up, you can also ask the bank for an appraisal that you as the consumer get to pay for, and as long as you can show them that you do have that 20%, they can remove that mortgage insurance beforehand. Lots of times though it isn't worth it to spend $700-800 on a appraisal where it could not work out in your favor as opposed to just paying the mortgage insurance. The estimated taxes and insurance and assessments is $206. They're asking for that in escrow, and it says in here that the amount can increase or decrease over time. Estimated closing cost and estimated cash to close are these two numbers here. Those are also very, 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 very important numbers because at closing, the borrower is going to be expected to walk into closing with $16,000.54. That number will typically almost always change due to a lot of things, but typically not by very much. Then we have the closing cost details. We talk about the origination charges, services that you cannot shop for. Remember, origination charges is stuff that has no tolerance. Services you cannot shop for have the 10% tolerance. Services you can shop for have that 100%. Because the bank is saying you can hire any survey company that you want, and they have $65 on here for a survey. I want that survey company's number today. Pet inspection fee for $135. I don't need that pest inspection company's number. Nor do I need this title insurance company. That's a little pricey. But the insurance binder, all those things, the title stuff, you can choose any title company. Typically, the title search is done by the attorney. The other costs are taxes, the recordation fee. We know that there's excise tax in there. Homeowners insurance premium, stuff that you have to put in escrow or stuff that needs to be prepaid. Owner's title insurance policy, again, that's really expensive. Total closing costs, and there's no lender credits. And then we calculate the cash to close. We see in there that they made a $10,000 earnest money deposit, which will come off their cash, because that's cash that's already been paid out. Then on the final page of 583, which is page 3 of 3, it kind of just gives additional information about this loan. This is a real good piece of paper if you're shopping around the different loans. This kind of gives you your one-page look at what this loan has to offer versus what another loan has to offer. Any questions about the loan estimate? So when you apply for the loan, you're typically going to get the loan estimate. And when your loan comes back, normally you will get something called, this rate is good for this time frame. Your lender will send you that. So we know how we said that loan interest rate has an unlimited tolerance. That's because the bank does not know between the time that you apply for the loan and your closing what those things are, what the federal interest rate or what the Fed rate is that's kind of where they calculate that. Normally they will give you 30, 60 days of an interest rate lock. I know that on my last house, I closed the final day that I had my interest rate. Because interest rates had gone up, and this was a couple years back. Interest rates had just gone up like a week before, and I knew if we didn't make that, and actually the owner was still in the house when I purchased it, and I just rented it back to her for a month while she finished moving all her stuff out, and there was a problem with her closing on her new house. So we made it all work out. It was great. She got to stay an extra month at the house at probably a third of what I would charge her market rate for rent, and I got an interest rate about, I don't know, 0.5% lower than I would have if she didn't do that. So we found a win-win on that one. Any questions about how the TRID loan application, what you're going to get, what you expect to get, talking about that, thinking about it? being able to explain these documents to your clients. I'm taking silence as Chris, you're doing such an awesome job. I don't have any questions. So, at closing, we have the bank's closing disclosure. Talked about the variances. So we need this closing disclosure either 3 or 6 days before closing. At the bottom of page 590, we get kind of the definition of that. So the borrower's closing disclosure was emailed 6 days. If it was personal, it's 3 days. So personal delivery means handing it to the borrower in person, and the other means is mail, fax, email, smoke signals, hiring a plane to write it, and skywriting, any other means. Actually, I don't think those last two actually work. It needs to be a paper document. But any of those other means, 6 days. Why is that important? What's happening in between the time that you get the borrower's closing disclosure and the closing? Reviewing. Review. Double check, dot I's, cross T's. Make sure that all the stuff that was sent to the attorney is there, making sure that that pest inspector that this happened on one of my loans, house before this, when our pest inspector guy came out, it was a friend of ours, my wife paid him in cash. You'll be told there's no paper trail behind that. And I said, what? And we were sitting down with my wife. I said, okay, well, here it is. It's a good rule of the number. She said, no. I paid Integrity $60 cash for them to do the pest inspection. Nobody knew that. Put the phone, call the attorney. Yeah. Integrity Services has already been paid. Yep, they're good. Take that off. Great, boom, done. I had a client one time, similar thing happened. Ended up after closing that the check that was written to the home inspector, so then the home inspector said, nope, I've already been paid for this job. Sent the check back to the attorney, and the attorney just wrote the check, or actually emailed both the brokers and says, hey, this money was returned, that the home inspector had already been paid outside of closing for this. I'm just going to go ahead and release those funds to the buyer who paid for that. Is this consistent with what everybody would want? Everybody responded back yes, and so the buyer got a check for the $500 or $400 home inspection. But during those 6 days, we need to ensure accuracy, the broker's role. And then we need to make sure that prorations are correct. Was everybody super excited when they were reading this chapter to see all the math? Guess what we get to do this afternoon or this evening? Do math. Messy handwriting. It's gonna be fun. It's actually, the math isn't all that bad. It's more for understanding the prorations, making sure that the concepts are there. 99% of the time, the attorney's math is going to be good. Every now and then, it'll be like, oh no, this is wrong for the taxes. The seller has already paid the taxes, or the seller paid the taxes yesterday, which was 2 days before closing. And then everybody's like, oh, why did you do that? So things along those lines. All those things always happen. So that is what needs to happen with the borrower's closing disclosure. It needs to be delivered either 3 or 6 days before closing. Your role as the broker to explain it, to ensure its accuracy, and to make sure all the math is correct. So, we need to prepare the closing disclosure. Who does that? The attorney. Makes sense to me? So in preparing a statement, there's going to be debits and credits and things like that. So when I think of a debit, I think about it as something paid by the buyer or seller. So something that coming out of the seller's funds or coming out of the buyer's funds. A credit means it's something that is owed to the buyer or the seller. So, some things we have to prepare on there. Broker commission. Who typically pays for the broker? Seller. Seller hires a listing agent. The listing agent is a member of the board of realtors and a member of the MLS. And they put in their listing agreement that I'm charging you, I'll just pick a random number, 6% to list your house. And I will be retaining 3% of that, and I'll be offering any cooperating agent who's also a member of the MLS a 3% buyer's commission for their time and trouble of bringing a buyer into the transaction. So in that situation, that would be a debit to the, coming out of the seller's money, the seller's paying for that. Attorney's fee, who's simply paying for that? Buyer, debit to the buyer. Recording. Depends on what we're recording. Typically it's the seller. If we're recording the payoff of their existing mortgage, things along those lines. Excise tax. Title work. It can be both.
Either or.
Title expenses typically are going to be paid for by the buyer. However, if there is a problem on the title, typically it's the seller's responsibility to get that cleared up, to get some sun shining on that cloudy title, get that all worked out. Typically it's done with a quick claim deed or something along those lines to say that, you know what, nobody coming before me is going to have any problem with this. If they do, it's going to stop with me. Loan fees, again, it can apply to both of them. There's a prepayment penalty, that's going to be the expense of the seller. Origination fees is going to be paid by the buyer. Reserves, depending on what's being reserved, that's always going to be paid by the buyer if it has anything to do with their new loan. Appraisal surveys, all that good stuff. All right. Let's talk about some other stuff on here. What's the excise tax in the state of North Carolina? $1 for every 500. Easy way to factor that. Easy way to determine that. Take the sale price divided by 500. If you ever want to know what somebody paid for a property, you can go on the county records and look up their deed. And you can see there's a little stamp at the top that says excise tax paid. $400. How much did that person pay for that house? $200,000. Quick and easy way to find it. But the county records typically have the previous sale prices on there anyway. Title work, we talked about that. Loan fees, we talked about that. Who pays for appraisals? Buyer, if it's going to be for that. I know a lot of sellers who don't trust real estate agents and hire their own appraiser before they list the property. Is that a good idea? 100%. It's going to prevent a lot of headache down the road where if they hire an appraiser, it says, you know, your house is worth $400,000. Hopefully, once you're under contract, that next appraiser is going to say that the bank hires that your house is also going to be worth $400,000. That at least gives that seller a good amount of assurance that the house is going to appraise enough, which is going to give them assurance that the buyer's loan will get through. Due diligence fee. Again, that is going to end up as a credit to the buyer because they've already paid that. And it could be other. You name it, it's on there. All sorts of good stuff. So that brings us into the wild world of prorations. So we'll talk about this slide and then why we live in a fantasy world called pre-licensing. Now we'll go to break and then we'll start jumping into actually doing some prorations. So, in the real world, does Halloween exist?
Yes.
Because it falls on October 31st, which is a real day. In pre-licensing class, does October 31st exist? No. Sorry. Halloween and New Year's Eve are no longer holidays until you graduate this class. In class, there are 360 days in a year and 30 days in every month. Makes math a little bit easier. Not a lot, sometimes it drives you crazy, but in the real world, that does not apply. However, in pre-licensing, just makes things a little bit easier for us. So, something that is accrued is an unpaid item. So interest has accrued means that interest is there, it needs to be paid, but nobody has paid it yet. Prepaid is an item that has already been paid by one party, typically the seller. Because when something might have been due, the seller didn't know who the buyer was. And who owns the property on closing? Seller. When does the bank want to start interest? On the day they loan the person money. And the money normally gets loaned to the person on the day of closing. So, the seller owns the property on closing, however, the buyer is responsible for interest on the day they get the money, which is typically the day of closing. So let's just all absorb that fact for a moment. Seller owns the property on closing. Straightforward. Banks want interest on the day they loan the buyer money, which is also typically the day of closing. Now, if we can get those two things straight, we can have a wonderful time prorating. Okay. All right. Any questions on those things? Good. Go to break.